We're 3 episodes into this series. I hope you guys have been enjoying the series so far. Week after week, we've been building on the skills that you'll be learning at NJT. We've already learnt the concepts, the logic, and the why behind the concepts. And today it's time to see exactly how we enter these markets and the abundance of opportunity this strategy gives us. If you can put what you learn in today's episode into a repeatable process, you'll have the ability to pass prop firm challenges, you'll be able to get yourself funded, and you'll make a lot of money online. So make sure you're focused, you take some notes, and you're ready to dive into episode 3. A good trade always starts with a great trade idea. So from our previous episodes, you know what to look for. We're looking for that structure, we're looking for RAMC so you can read the intention. You know the location to look for your trades at the edges of a range, or making sure that you're buying low or selling high in a trend. So now it's time to have a look at exactly how we can make money from this information. So I'm going to take you through 2 different ones. Keep in mind that you want a repeatable process for entry. That process needs to have in mind a safe stop loss and a repeatable entry pattern. So we're going to focus on 1 long and 1 short, and every setup that you see on the charts follows the same process of these 2 entries we're about to go through. Okay, so this is the first one on screen. Just to recap, we have a structure A to B. When we're thinking about trading location, we're at buy low locations and we're at the edges of this sideways range. So we're making sure that we're buying low. This is that whole sideways range here. Sideways range initiation. We're at that point of mitigation for a potential continuation phase in the market. We're also looking at inside this whole sideways range, we have an inside bar, which is a representation of a buy order. So we know exactly where we're looking. And now we're going to go down to the lower time frame. After we see the banks buying again, this is where we go down to the lower time frame here and zoom in for entry. So let's do that now, and let's zoom into the actual entry. Okay, so we're down here on the 1 minute chart. I've just zoomed out so you can just see the whole 1 minute chart before we start to zoom in. We're in the session, right? This is New York session, starts at 1 p.m. in the UK. And we're just mitigating out of that inside bar that we have here on the lower time frame. And remember, we're at a good location. We're at that buy low location. And now we're just starting to read the price delivery. So again, there's 2 main things we want to be thinking about when it comes to entry. We want to be seeing bullish order flow at a point of mitigation. And what is bullish order flow? That is sideways range followed by an initiation. Then when we pull back into that sideways range, we mitigate out of the orders from the sideways range. This is our entry. And then we're anticipating that continuation phase. This is showing the banks continuing to buy at a point of mitigation, right? So whether we're looking for buys or sells, obviously if it's on a sell, we're looking for this same pattern, but we're looking for it on the opposite direction, right? Now, the only thing that matters when we see this pattern is making sure that we have a safe stop loss that goes underneath the sideways range. So we really need to make sure that in our process, we see a bullish order flow pattern and we have a safe stop loss. These are going to be the 2 most important concepts when it comes to building an entry process. So just reading the price, right? We're at this point of mitigation. We can very clearly see that momentum has shifted here bullish. So now all we're doing is looking for price to create that sideways range, followed by an initiation to the upside. So as we can see here, price is contained sideways here between this high point here and this low point here. This is our sideways range initiation. That is the first part of our bullish price delivery. Now, when it comes to the execution, all we're going to do is think about where we want to put our entry and where we want to put our stop loss. So when we're thinking about the highest point to the lowest point, this is going to give us our entry areas. Obviously we have the open, we have the 50%. Now this really depends on the stop size that you want. If you're happy to go for those smaller risk to rewards of like a 1 to 5, then you can put your entry at the open and you can put your stop loss underneath the range. If you want to go for a higher risk to reward, then you probably want to put your entry more towards the 50% with your stop loss underneath the low again. So we'll look at both of them, right? So the first one, you could put your entry at the open, stop loss goes underneath the range, and you can have a 5 pip stop loss. And if you're targeting the highs here, you've got a potential 1 to 5 risk to reward. Now we go for those higher risk to rewards, so we naturally have a smaller stop loss, and the max stop loss we go for is a 3 pip stop loss. So this is how we would play this. And again, you can see that that same risk to reward becomes a 1 to 10 pretty easily. So depending on how you want to play this, it's completely up to you. There's no wrongs and there's no rights when it comes to risk to reward. It's what you're comfortable with. As long as you're playing the pattern and as long as you have a safe stop loss, risk to reward is completely up to you. So as we can see here, we're anticipating that we're going to get that pullback into the range. We see a reaction, which is the mitigation from those orders, and then we play continuation. And to just remind you, when we go back to the 15-minute chart, we can see this FU wick, which is the banks buying already. So when we get back to the 1-minute chart, all we're doing is waiting to see that continuation there to the upside. We know we have a safe stop loss here. So let's play this forward. As we can see, the initiation continues, then we start to get that pullback. We pull back into the sideways range. This is where we anticipate this reaction. Now you can either set a limit order or you can wait for price to get here and market execute. We get the reaction here. And as we can see, then price sees that continuation there to the upside. When price takes out this high, this is a great location to move your stop loss to break even. And now you're in a risk-free trade. Now we're just going to zoom out and see how price continues all the way up into the high, and we target those equal highs there to the upside as well. And that's the equal highs that we had there on the 15-minute. And as you can see, it's just about having a safe stop loss, playing this repeatable entry pattern, and the market does the rest, right? Price could have moved up, come back and taken us out for break even, or even taken us out for a loss here. It doesn't matter, right? As long as you're playing the same repeatable process and you play it over a series of trades, that's when you're going to win over a series. So that's the first entry that we just looked at. Very logical way of trading, and obviously then depending on the risk to reward, a 1 to 5 or a 1 to 10 for you, depending on how you want to use your risk to rewards. But we're just using that same process when it comes to entry of zooming in to the location that we want to trade from based on the facts of the market. We wait for the market to show its hand and show us it wants to move higher, and then we look for that bullish order flow pattern with a safe stop loss. So let's do exactly the same now. So I'm going to share with you now a sell continuation that we can look to get involved in using exactly the same repeatable process. Okay, so we're back on the 15-minute chart again. We can see the structure here, we're in trend. We've got a high, low, lower high, and obviously then we create this lower low at this point. We do get that pullback, and then we create this lower low here. Now, a lot of people will look at the structure and say that this is that next lower high and that next lower low. Now, the reason I'm not looking at that as my next lower high and lower low is because if I take this high to this low here, price hasn't pulled back into premium. So this is still a part of that leg down. So as soon as price creates this low and then we get a pullback, that then becomes the whole A to B price range in the market. Then we have premium prices here and we have discounted prices. So when we're in trend, we want to make sure that we're selling at a premium price. So the only ranges or the only OBs that I'll be looking for are the ones created at a premium price. Now here we have that FU wick, which again, if you've been watching the previous episodes, you know that an FU wick is a representation of a buy to sell in the market, which is sell orders. So when price comes back here in the future, if we zoom in here and we start to see that bearish order flow pattern on the 1-minute chart, this is where we're going to be looking to get involved in those opportunities, because the banks are showing that they are continuing to sell at a previous sell order in the market. So let's zoom in here now on the 1-minute chart. Let's look for this process, which is looking for a pattern and having a safe stop loss. Okay, so we're down here on the 1-minute chart. We're obviously at that point of mitigation from that FU wick. And as we can see, the same repeatable process, right? All we're doing is looking for that sideways range. We know that inside sideways ranges, orders are created, and because they're happening at a point of mitigation and we see the intention being shown away from the sideways range, this is our bearish order flow pattern at a point of mitigation. So that's the first thing that we're looking for, right? Sideways range and initiation. When price pulls back into this sideways range, this is where we can execute our order for that continuation to the downside, and then we move to break even as soon as this low gets taken out. When we're thinking about part 2 of this entry process, part 2 becomes about making sure that we have a safe stop loss. Now, the safest stop loss is going to be above this high. And the reason it's going to be above this high is because if price moves above this high here, we're not playing this bearish order flow pattern anymore. Price is going to create a new structure in the market, which means then that we're wrong with this entry. So if we're wrong, this is the location that we'll know where we're wrong from. And that's why we always put our stop loss above range highs or below range lows. So you can see here again, if you had put your entry at the open, again, you're going to have a bigger stop loss. Again, absolutely nothing wrong with having a bigger stop loss. If you want a bigger stop loss, that'll be 4.5 pips. If you wanted the 3 pip stop loss, which is our maximum, that's where you're going to put it more towards the 50% of this whole sideways range here. again with your stop above the high. So you can see that we always repeat the same process when it comes to execution. It is always about seeing bearish order flow pattern, and it's always about having a safe stop loss. As long as these two processes are a part of your entries, your only focus then is to make sure that you execute every single trade absolutely perfectly. And again, we always go for those 1 to 10 risk to rewards. If you wanted to have a smaller risk to reward but a bigger stop, again, absolutely nothing wrong with that. And then you can go for those smaller risk to rewards of those 1 to 5, 1 to 7s, so on and so on. And I say these are smaller risk to rewards. Creating a 1 to 5 or a 1 to 7 in a risk to reward is still an excellent risk to reward to have in the markets. We just know that we can get those 1 to 10s with the system that we have. And I hear a lot of traders say that they struggle with patience, and how easy is it to be patient when you know exactly what you're doing and you want to wait for your setup because you know you're likely to win. Sometimes you have to mitigate having to be patient with having a strategy that you actually believe in. So instead of focusing on a weak point, you're focusing on something greater so that the lesser falls away. Back to the 15-minute chart, we can see that intention continues to the downside and we end up taking out that swing low, which would be a great take profit location as well. So that's the end of this technical part of this episode. I hope you guys can see how repeatable and simple you can make your trading approach. Once you understand the logic, this part is very easy. The direction and the intention is where the work comes in, and the entry is all about having that safe stop loss with that repeatable entry pattern. These are all concepts that you can learn through NJT, through our trading floors, during London and New York session. And of course, we always have video breakdowns of exactly how we use these concepts as well. So today's psychology topic is going to be about the flow state. So we're going to go straight into this now. So what does being in the flow state mean? Now, everyone has read trading in the zone, but what does trading in the zone actually mean? And for me, this means recognizing the market movements ahead of time. This is how you will trade something, and being able to read the market and the candles and the intention from the bank's perspective. Now, we went over in episode 2 about who's in control of the markets and who we should focus on the most for their moves, and that is the banks. So we need to read the market from the bank's intentions, and then we'll be in flow with how price actually moves, or the intention of price. So this is not about what you want, this is about what the market is actually showing you. So you need to be prepared for that next move in the market and be fluid with the scenarios, because the market can change very quickly when we're day trading. So recognizing that change means reading the candles and having your scenarios right. If the market's looking like it's coming into a point of mitigation, how could price potentially change its intention into a bullish intention from here? Or are we just going to react out of this location, create a range and continue to the downside? And how would that start to look? And what are the best locations that you can look to trade from? And what do you want to see from those locations on the lower time frame for you to trade? That's being ahead of the market, that's being prepared and knowing how you will react to the market, right? And your scenarios are different to how the market is actually printing. So you need to have these scenarios ahead of time, but also read the markets from its perspective. And when the market's showing you one of these scenarios, that's where you can start to be ahead of the market, where you can be in the flow with what could potentially happen, and then you go into your execution mode. And I always say to myself, trade what is, not what isn't, meaning that I trade what the market is actually showing me, and I don't try and force what I want into the market. So how do you actually recognize when you're in flow state, right? Well, as we know, trading with the higher time frame direction and higher time frame momentum is very important, because we know that the lower time frame delivery is built to support that higher time frame direction. So if you're trading with the higher time frame intention on the lower time frame, it's going to be easier to read that direction and the candles and what price is printing from its perspective and its intention. So a lot of the time it's literally just about trading with the higher time frame intention and matching the higher time frame and the lower time frame together and putting yourself on the right side of the market, because all being in flow state means is you're reading the market from its perspective, or you're reading the intention of the big banks, which is either higher or lower prices. All the concepts that we have, these are just tools to make sure that you get into the market at better locations, you have a safe stop loss, and you have a way of actually reading the market. So of course it helps to have a process, because that's what gives you that repeatable approach to the markets. And once you've been through our course as well, you'll be able to have that process that is repeatable. And of course, this brings us on to the next point, right? What does it mean to be out of the flow? Well, it's the complete opposite of being in the flow. So it's forcing what you want into the market. It's trading against the higher time frame intention. So this could be something like trying to catch every single reversal, trying to pick tops and bottoms in the market, come into the market with a bias. And I need to say this as well. Coming to the market with a bias is not wrong, because I sometimes come to the market and I have a very clear bias, but that's when the market is very clearly bullish or bearish. You need to know when to be open, and typically when you'll want to be open is when we're at those higher time frame mitigations. We're seeing aggression and speed in the opposite direction of what you thought the price would go, and when we're in a very clear sideways range. Any other time, for example, if we're in a bearish trend, I'm going to have a bias of lower prices. If we're in a bullish trend, I'm going to have a bias of higher prices, especially if we've come from a higher time frame mitigation and the aggression and speed is bullish, or the aggression and speed is very clearly bearish. That's the times to have a very clear bias on the markets, because the market is showing you it wants to move higher or lower. So now you're in flow with how it's actually moving and what the market's actually showing you. Now, when price is very clearly bearish and in a very clear bearish aggression and speed initiation to the downside, and you're trying to look for buys, you're definitely out the flow of what price is doing, because you're forcing what you want into the market. You're trying to catch that reversal. You're trying to pick that top or bottom in the market. And that is not understanding the market from its perspective. The more experience you get as well, the quicker you'll be at noticing when you're out of the flow, and also when you're noticing when you are in the flow as well. And like I said, being in and out the flow is just listening to the language of the market. It's reading the candles. It's understanding what could potentially come next, and reading the market from its intention. How do you recognize when you're out the flow? And you can see this after the fact, which means obviously you might have taken a trade, you might have taken a loss, you might have got the complete wrong direction. Then you can realize that you're out the flow of what price was actually showing. Or you can see it in the moment, and this would normally be with your entry, or the order flow that you're playing doesn't play out and doesn't hold as you would expect. So in simple terms, being out the flow just means you're wrong. This means you're wrong with price. You're not understanding the market flow from its perspective. And you can be wrong, obviously, with your direction. Being in the flow means you're right, you're correct. You're understanding everything from the market's perspective. You're reading the market intention correctly, and you're able to trade that direction and trade your system perfectly. Out the flow means you're wrong. Normally when you're quite emotional, you may be frustrated and you're not actually reading the market and getting into the flow of what it wants. And you're not actually reading the market from its perspective. You're forcing what you want into the market. So let me know down in the comments if that's helped you to understand the flow state. It's very simple terms. Next week's episode, we're going to start to put all the information that we have into a trading plan. I'm going to show you how I build a trading plan, all the elements that I put into my trade system as well. And I'm going to start to show you how we can put this into a repeatable approach so that you can have a system that you trade with to make some consistent returns from the market. Thank you all for watching. Make sure you leave us a like and comment down below if you're enjoying this series. If you wanted to become an NGOT trader, make sure you visit our website at notjustatrade.com. And we'll catch you guys next week for episode 4.